Hello everyone, and welcome in a new trading session for today. It's the 26th of July already, and this means that we will be having the FOMC meeting or the conclusion of the FOMC meeting today. So basically, the FOMC meeting is the Federal Open Market Committee. It started yesterday, and throughout 2 days, they conduct this meeting to take a decision about the interest rates on the US dollar. For sure, this is the most important, let's say, news release that we follow in the markets. It affects the US dollar, gold trading, and almost everything in the markets, from the US to currencies to the stock markets, and even the bond markets are affected. So today we're going to discuss what are the possibilities. Basically, the meeting concludes after 30 minutes from now, which will be 10 p.m. Dubai time, which is 6 p.m. GMT. So after 30 minutes, we will know what is the decision from the FOMC, or the Federal Reserve, which is the US Central Bank, whether they will raise interest rates any further, or they will fix interest rates as the current percentage, which is around 5.25%. What are the possibilities? What are the outcomes? And today, basically, I do really love to live stream during this news event, because basically a lot of traders want to understand what happens and what are the possible scenarios, how to trade each scenario if it happens. I cannot tell you for sure that this will happen. However, what we normally do is I give you options, I give you scenarios. If this happens, so markets will react or should react in this manner. If the other scenario happened, the market reaction will be different in this manner, and so on. So we are ready with our tool set, with all the scenarios and options, the outcomes from the FOMC, and we will discuss what will happen after 30 minutes. And before even the news release, let's discuss what is the main thing that we will be looking for. We will have time also to discuss the technical analysis. What are the charts telling us? What is the nearest support and resistance? And we'll discuss mainly the financial assets that we are interested in, which is the US dollar, gold trading, US oil, the Dow Jones, the S&P, and even the main currency pairs like the euro dollar, the pound dollar, etc. If you have any questions, please leave it in the comment section below. Whether you are watching this on YouTube or in any other streaming platform, please make sure that you leave us a comment if you have any question, and maybe every 10 or 15 minutes we'll conduct a very quick Q&A session or question and answer session to provide you with the information that you need. So sit tight, get relaxed, and let's start this live stream right away. I want to start with a really quick look on the economic agenda for today. Basically, we had some numbers from the US economy, which is the most thing or the most important thing that we are concerned with for today. It was regarding the home sales and the US crude oil inventories. And basically, as you can see here, most of the data came out in the negative zone, in the bearish zone. So when it comes to the new home sales, basically, it fell short from the previous month, as well as below the forecast or the expectations for the month of June, as well as the percentage of increase or decrease. It was a negative 2.5%. That's for the new home sales. That was the same as well for the crude oil inventories. So most of the data today was basically in the bearish zone. However, it didn't really affect the markets, because the main thing that we will be looking for today is the FOMC statement, the federal interest rate decision, and the FOMC press conference. And let's discuss each one of those. This will start basically after 24 minutes from now. We will have the federal interest rate decision, which is currently around 5.25%. This is the current interest rate on the US dollar, okay? The Federal Reserve has many options, or basically three options. He can go for a raise for the interest rates, or fix interest rates as it is, so it doesn't change it at all, or basically decrease interest rates. What the most probable scenario out of today's meeting is an increase in the interest rate with 25 basis points, which is a quarter of a percentage point. So from 5.24%, we are expecting today with a 99% probability that it will be increased, or as we say, hiked into 5.5%. This is what we are expecting today. However, this is not the main thing, because if I know for a fact that with a 99% probability that the Federal Reserve will raise interest rates, okay, and you also know this, everyone in the market already knows this, the markets will not react with the Federal Reserve interest rate decision because it's already priced in the market. Most of us already know that we will see a rate hike with the 25 basis points. However, the main thing that we will be looking for, which is we call as the forward guidance from the Federal Reserve. Okay, so in this meeting, we will have a 25 basis point rate hike. Okay, what about the next meeting? The next meeting, by the way, will be in September. What is the monetary policy for the Federal Reserve going forward after today's meeting? Will today be the last interest rate hike, or will we see another interest rate hikes in the upcoming meetings? That's the first question. The second question is, if we won't see other interest rate hikes in the upcoming meetings, when will the Federal Reserve start reducing or decreasing interest rates one more time? Because probably 5.5% as interest on the US dollar is something that should hurt the US economy a lot on the long term. So it couldn't stay that or there for long. It should be reduced one more time. So when will this happen? All of this basically is the forward guidance. So today we are expecting a rate hike of 25 basis points, but going forward, what should we expect? Should we expect more rate hikes or rate cuts, or maybe fixing interest rates around the same possible or the current rate? That's the first thing. So the federal interest rate decision, it's currently 5.25%, expected to increase to 5.5%, which is something I do agree with totally, because it's not my opinion, it's not your opinion, it's something that we check on the market sentiment. We do have the Federal Watch tool, okay, that you can see right now on the screen, and you can see the current target rate, okay, is 500 to 525, which is basically 5% to 5.25%. This is the current rate. And you can see with a 96.5% probability that this rate will be increased to 525 to 550. So the difference between each number is 25, which is an increase of 25 basis points. And this is what we're expecting to see during today. So with a probability of 96.5%, today is going to be a rate hike. However, what else do we want to see? Not only the federal interest rate decision, which will be announced in 20 minutes from now, but also after 20 minutes, we will have the FOMC statement. What is the FOMC statement? The FOMC is the Federal Open Market Committee, which is the committee in the Federal Reserve responsible for setting out the monetary policy for the US economy. So when they meet, each meeting, they should release a statement with their decision and what were the catalysts or incentives for this decision. So let's say we have raised interest rates. Why? We have decided to keep interest rates as it is. Why? Etc. Etc. So during this or included in this FOMC statement is always an explanation of why they took this decision for the monetary policy at that exact time in the US economy, and sometimes it provides some forward guidance. So sometimes it includes that we will have more interest rate hikes in the future, or sometimes they say that we will not be waiting for or looking for more interest rate hikes, etc. So it's not really a big deal. It's only a short statement, probably like 5 to 6 paragraphs. And whenever it's released, which is after 20 minutes from now, we will open that live for you and we will have a look on it to see what are the key statements that might affect the markets. Because as I told you, markets will not be reacting with the interest rate decision, which is already priced in. However, markets will be reacting with any hints or clues from the Federal Reserve about the future monetary policy, which is we call as the forward guidance. So that's the first two things that we will be looking for. After 48 minutes, which is basically after 30 minutes from the federal interest rate decision and the release of the FOMC statement, we will also have the press conference. The press conference is where Jerome Powell, who is the Federal Reserve Chairman, basically goes out to the media and to the public in a press conference. He starts the press conference always with reading the FOMC statement, okay? And after this, he opens the door for questions from the news, newspapers, and media, news reporters, and so on from CNN, BBC, etc., etc. So they start asking him questions for things that he didn't or they didn't mention in the FOMC statement. It wasn't so clear. They tried to trick him into saying extra more information to the markets, and this is when the action gets real because he's asked questions he shouldn't be asked or he doesn't want to answer. And this is when you should really focus in the markets because this is when things get a little bit real. So we will start off after 30 or 17 minutes from now with the interest rate decision, a rate hike of 25 basis points. We will have a look on the FOMC statement. Whenever we check both of them, we will have like 30 minutes. We can continue our technical analysis during this period. And after this, I will be live streaming for you Jerome Powell live on from the YouTube. You will see it here on our channel. And in the comments section below, you will find me following up with you the press conference and any important statements or key statements that I believe will affect the markets. I'll be writing this down in the comment section. So if you want to really understand what will gonna happen today, all you need to do is just to sit back and relax, follow this live stream from ONEPRO, market research team on ONEPRO, and we will definitely explain everything for you. We do have time right now, probably around 16 minutes. Let's have a quick look on the technical analysis and the charts. What do we have currently? Where's the dollar? Where's the gold trading at? What do we expect from the technical side and how could we trade during the news? All of this will be discussed quickly right now in maybe 15 minutes before the news. Let's go to the technical analysis. Okay, starting off with the dollar index. Basically, if you follow ONEPRO on YouTube, I normally publish a daily video for the technical analysis where we discuss what are we expecting to happen from the technical side, okay? So we mentioned during, I believe, yesterday's video that we would expect a downward move to happen from the 50% Fibonacci on the dollar index because we mentioned this on the 4-hour time frame. We said that the downward move on the dollar index was basically retracing, and we do believe that the 50% Fibonacci retracement was enough for this retracement, and we expected a move lower. How did we decide that the 50% was enough and we're not gonna break above? Basically, it was the momentum. I always discuss this during my live streams or even the daily videos. Because if you're having upward move, and let's say this is an upward trend basically on the 1-hour time frame, if you're having higher highs and higher lows on the chart, okay, whatever the time frame is, prices are able to record new highs and new lows, new higher highs and higher lows. However, prices on the momentum or the chart on the momentum, you can see that the momentum is not able to make new higher highs. You can see that the momentum is weak. It's going down. Prices are going up. Momentum is going down. This means that even if there is an upward trend on the chart, on the prices, I mean, there is no strong enough momentum to continue the move upwards. And as soon as we reach a strong resistance, this upward move will end. And that's why we expected during this week that the 50% Fibonacci retracement will be enough for this upward move, and we can expect a move lower, okay? Whatever the way that you basically check or catch the trend with. There are multiple ways to catch the trend. So first of all is basically the trend line. Okay, some or a lot of people basically draw a trend line. If you are someone who draws a trend line, so this is our trend line here on the 1 hour time frame, it has been broken, retested, and the dollar is going lower. That's the first indication that this upward move has ended. Number two, if you're someone who follows me, for example, or someone who by any chance, by any luck, basically uses the same indicator that I use to catch the trend, which is this one that I have on the chart, which is called the super trend. You can see that the super trend was basically bullish. It was green all the way up. We had this period of consolidation here, after which the super trend here is now bearish. So that's another sign that the trend is going lower. That's on the dollar index. The third thing is, which I sometimes or a lot of times also use, is the market structure. What's a trend line? What's an upward trend? Okay, an upward trend is a new high, okay, which is higher than the previous one, and a new low, which is also higher than the previous one. So as long as you're able to see higher highs and higher lows, this is basically an upward trend. What happened here was basically a new lower high. So that was the first change in the market structure. And then we recorded a new lower low. So this basically, to me, ends the upward trend. Can you see what I can see here? Yes, it is basically a head and shoulders pattern. So here's the left shoulder, here's the head, here's the right shoulder, and we broke to the downside. So it doesn't really matter what's your way of analysis is, because basically the technical analysis at the end is sort of all connected in a mean or in some way or another. If you basically spend time to understand technical analysis, it's at the end you will find that it's the same thing that we are looking at, but everyone looks at it a little bit differently depending on his eye and what he's basically trained to see. However, at the end, let's say that technically the dollar index here seems to me that the upward move, which is a retracement of the previous move lower, has basically ended. So yes, technically, and this is regardless of any news that will happen right now, because yeah, during today we might see an upward move on the dollar. It all depends on the Federal Reserve and how things will go. However, from the technical side, I do believe that the dollar index still has room to go lower. Okay. So to be honest, even in the most bullish scenario on the dollar index today, I do believe that we might see an upward move. Okay, after which we should technically continue the move lower. So if you're someone who is looking to trade the US dollar, my personal opinion is wait after the news and we will be catching some short trades on the dollar. Let's take the opposite. Let's just completely reverse what we have explained here on the dollar index, and you will see that we can find exactly the opposite taking place on the euro. Okay. The euro was a little bit different because the euro, we expected this downward move to end just around 1.1090. It a little bit went lower than that. However, it's the same concept. Why is that? Because basically the prices were moving lower. Okay. How about the momentum? Momentum was basically going higher. So this is a bullish divergence. That's exactly the opposite of what we have just explained on the US dollar. Prices are moving lower on the euro. However, momentum is going higher. So momentum is telling you that this downward move, this bearish pressure or selling pressure taking place, is not really supported by any momentum to the downside. So we expect a reversal soon. The nearest support to me was basically the 1.1090. It went a little bit below that to the 50% Fibonacci, and we can see here, to me, that seems to be some sort of consolidation here. So this consolidation after a move lower, to to me basically is a bullish indicator or a bullish signal to me on the euro versus the US dollar. And if you have been following me for some time right now, even if you're following me on LinkedIn account, you know that I've been discussing for a while now that the euro and the pound, although both currencies are strongly linked to the US dollar, however, the pound for some time has been leading the euro. Why is that? Because if the euro is moving lower and still consolidating, you can see that the pound already started to move higher. Okay, so what's happening on the pound basically supports, to me, in my opinion, that the euro should follow, should start moving higher, and both of them should basically affect the US dollar and cause more downward pressure. During the beginning of the week, we expected the pound top around those levels of 50% Fibonacci, which is around 1.2850. You can see this on the 4-hour time frame. We expected a move higher. The move higher basically went really good. Okay. And what's happening here on the pound? Yes, as I again told you, that it's an indication to me that the euro should go higher. Okay. It was the same exact reason why I personally bought the pound dollar. Prices were moving lower and momentum was going higher. From the nearest support, you are going long. It's not 100% sure thing or not 100% guaranteed trade. However, it's something that most of the time goes in the right direction and makes you profit. This is my strategy, to be honest. Okay, let's have a look on the dollar versus the Japanese yen. The dollar we mentioned, I think it was the last or the end of last week. We said that what's happening here on the dollar versus yen is that we are having a lower high, a lower low, pardon. So this is a lower low, even if it's slightly lower, it still shows that this selling pressure on the dollar yen was something new. It pushed prices to a level that was lower than the previous one. Okay, so we agreed that this upward move, the recent upward move on the dollar yen, is nothing more than a correction. That's why we started to see the Fibonacci retracement from this downward move to have our targets or to have our areas where this upward correction is supposed to end. And you can see that it ended well around the 61.80% Fibonacci. And that's why, yeah, that's the correction. That's the upward move. That was a corrective move. It ended just below the 61.80%. And to me, this concludes the upward move on the dollar yen, and we should continue to move lower. However, just to be honest and just to be completely technical here with you, the move lower from here is not really good. It's not something I really prefer because the momentum is still not so strong to the downside. Okay, sorry. Yeah, that's what I'm talking about because momentum is not so to the downside. Okay, if you're someone who ever traded with 88 waves, you should know the difference between an impulsive move and a corrective move. This, after reaching the levels of 61.80%, should have been an impulsive move lower. However, to me so far, it's a corrective move from the corrective move. So things are getting a little bit complicated here on the dollar yen. That's why I'm not trading basically the dollar yen. However, if we combine what's happening on the dollar index, what's happening on the euro, what's happening on the pound, and the dollar yen roughly, that's why I personally prefer selling the dollar, the dollar index or the dollar overall against most of the currencies. Of course, let's see what's happening here. How much time left? We have 5 minutes left to check the news. And basically for gold, what's happening on the 4-hour time frame, which was something we discussed, I believe, 2 weeks ago or 3 weeks ago. it's an inverted head and shoulders. It was a brilliant one, and we had our targets around 1983. We reached the targets, and on the short term, I believe we might reach the levels of 1983 one more time before going down. Uh, let's wait and see what will happen today. But to me, technically, I'm more in favor of buying gold on the short term. Okay, let's get back real quick to the agenda, the economic agenda, because it's almost like 4 minutes left. Let's see what will happen and get back to the charts later. Okay, so it's only 3 minutes left. And let me get you the POMIC statement, or I'll get the website for the Federal Reserve ready. So whenever it's published, which is after 3 minutes exactly, we will be able to see and check the POMIC statement. And guys, just to remember, if you have any questions, please leave it in the comment section below on whatever streaming platform that you are on. And I'll make sure that all of the questions will be answered before the end of this session today. So yeah, here I got the Federal Reserve website, and the news are after roughly 3 minutes. It's still 96.5% for a 25 basis points high, which is, yeah, we will see this. Having a quick look on the markets, the US Dow Jones is basically moving in a sideways, nothing pretty much happening. We mentioned that we do have some resistance on the Dow Jones. However, unlike a lot of financial assets or pairs, which went really well as we expected during the last week, the Dow Jones is not so very good following our analysis so far. However, let's see what will happen today. For the last, let's say, for 6 meetings, let me remember, 5 or 6 meetings. For the last 5 or 6 meetings from the Federal Reserve, the US Dow Jones, regardless of what the outcome of the Federal Reserve meeting is, the Dow Jones jumps with around 1 to 2% up in profits. So if you want a trade, which is not 100% sure, but a highly probable trade, buying the Dow Jones with the Federal Reserve is something I've personally done. And I'll be waiting for the results. Hopefully that we don't have, a new outcome from the Federal Reserve that should change this trading behavior on the Dow Jones. We are almost like 1 minute away from the news. Markets are not doing any changes at the moment. Still waiting for the news. Okay. It's almost 10 p.m. here, Dubai time, so it's 6 p.m. GMT. Just a matter of seconds here, guys. Matter of seconds. Here we go. It should be 5.5%. Investing.com is a little bit late, a little bit lag here. Refresh the Federal Reserve. Okay. The Federal Reserve issues the following statement. Raised the target range. So yes, it has been increased to 5.5%. And this is what I can see here on the FOMC statement. And this is the FOMC statement, guys. I've just got it real quick. And yeah, let's read quickly what are the changes. And before doing this, let me just give you a quick update on the market, which is doing nothing at the moment. A slight decrease on the dollar index. Of course, some upward moves on the euro, the pound, as well as gold. Only $1 difference. So yeah, as I told you, we don't really expect markets to behave or to react violently with increasing the interest rates, because that was really expected, okay? However, Let's read quickly what's happening here on the FOMC statement. Other traders are basically reading this right now, and they will start to react in a matter of minutes. And of course, after 30 minutes, we will be having a look on the FOMC statement. So recent indicators suggest, let me get this from the beginning. Why is it not showing here? Okay. The beginning of the FOMC statement, I think it's not clear for you, but let me read what you're missing. Recent indicators suggest that economic activity has been expanding at a moderate pace. Job gains have been robust in recent months, and the unemployment rate has remained low. Inflation remains elevated. That's the first paragraph. And guys, it is a complete copy paste from the previous FOMC statement. The US banking system is sound and resilient. Tighter credit conditions for households and businesses are likely to weigh on consumer activity. They have been mentioning that the US banking system is sound and resilient since March, when we had some issues and troubles with the banking system in the US. The extent of these effects remain uncertain, and the committee remains highly attentive to inflation risks. Guys, another second paragraph, which is a complete copy paste from the previous statement. The committee seeks, I can now see that you can follow me here. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run, which is the actual or the normal goals. In support of these goals, the committee decided to raise the target range for the federal funds rate to 5.25, which is 5.25 to 5.5%. So basically a 25 basis points up. The committee will continue to assess additional information and its implications for monetary policy, copy-paste guys, in determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time. The committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation. This statement, I believe, has been added or maybe during June of last year. So it's again a copy paste. The committee will continue reducing its holdings of treasury securities and agency debt and agency mortgage-backed securities, which is the MBS, as described in its previously announced plans. Nothing more. Basically, they say nothing. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The Federal Reserve has been doing something which is really bad for some time right now. Really bad for us as traders, okay, or investors in the market. However, it's the right thing to do, which is called the data-dependent policy. If you don't know what the inflation will do, how employment will behave, what will the economic indicators will do, and so on, you cannot have any solid forward guidance. So they have been doing this for the past couple of meetings, and they say that we will continue to monitor the implications of incoming information. So according to data that will basically evolve, okay, we will react to the changes and the updates of the economy. So this means basically that we don't know what we are going to do in the next upcoming meetings. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessments will take into account a wide range of information, including labor market conditions, inflation pressures, and expectations of inflation and financial international developments. So basically, they raised interest rate with 25 basis points, and no forward guidance has been provided to the markets in the FOMC statement. None. They continue to adjust or to follow the data dependency policy. According to data that will come, we will basically react accordingly. Let's have a quick look back to the markets on the charts. We basically have 25 minutes from now till the FOMC statement or the press conference. So yeah, right now we have discussed the federal interest rate decision. I told you guys it was highly expected to be 25 basis points, and it came with a rate hike of 25 basis points. Nothing new and nothing unexpected so far. For the farming statement, we have had a look on the farming statement real quick. Nothing unexpected. Nothing sounds like a surprise to markets. I haven't had a look on the markets right now, okay? However, the farming statement, as long as it doesn't contain any new statements or dropping of previous key statements, I don't really believe markets will have any reaction right now. And let's have a look in a moment. Exactly, that was what I meant. Guys, you can see that gold is doing nothing. Basically, yeah, we had a new high here on the 1 hour time frame. We had a new low. So we had buying and selling. This is the normal volatility or increased volatility during the news. However, what is the outcome so far? Nothing. Indecision. We are having very, very small body here. Uh, I do believe we'll have the same on the dollar, okay? Yeah, pretty much. We are having some selling on the dollar for the last 5 minutes. Let's say markets are selling the dollar at the moment, but I don't really believe that the farming statement has any reason for this. It's just pure technical, traders getting their positions. And let's see what is happening on the Dow Jones. Nothing. Slightly positive, slightly bullish, a slight move to the upside, and still, to me, this is indecision. Okay, let's open this 1 hour time frame. This is indecision to me. If you're having a high and a low, however, the body is really tiny, there is no surprise from the FOMC or the Federal Reserve so far. And that's for the Dow Jones. So yeah, let's discuss the Dow Jones technically right now. So I've been discussing this for the past 1 week, and as I agreed with you, the Dow Jones is still not so following our analysis. Why is that? We have very critical resistance levels on the weekly time frame. Okay. This is a weekly time frame, which is very, very big time frame for our intraday trade. However, whenever you are trading and whenever you're using the support and resistances, I always try to draw my support and resistances on a very large time frame, because this is when you know that they will have a great impact on the market, at least if we're going to see a correction from them. Okay, so this is a weekly resistance. It has been the Dow Jones has been edging higher for the past 3 weeks, okay, with no any corrections. However, the momentum, can you see the momentum here? It's not following up. You can see that the momentum is telling you that, yeah, although prices are going higher, I'm not able to provide new, fresh, positive, bullish momentum to continue the move higher. So with this poor momentum, I don't really believe that we can break a major resistance on a weekly time frame with it, okay? And to me, any break above this key level of 35,400, let's say, should be a false break to the upside. We shouldn't really stay above it for this time. Yeah, this is what I'm talking about, okay? Let's see this one. Since the 10th of July, on a daily time frame, the Dow Jones roughly never closed in the negative zone. It's only one candle here, okay? And it was a Friday. So this upward move with a resistance that we have on a weekly time frame, to me, it's impossible to break above with this weak momentum. We should at least have a move lower, even if it's only for a correction, okay? I don't mean we will have a reverse in trend. However, yeah, I do believe we should see a correction from the Dow Jones. And this is why I've been discussing shorting the Dow Jones for 1 week. We mentioned that we will be waiting for a new lower high, lower low, or lower high, basically, but we need the confirmation from market structure. So we didn't short the Dow Jones yet. However, we are waiting for a confirmation. If you're telling me that this is an upward trend and I will buy, I can tell you good luck with your stop loss because you're gonna be stopped out in this trade. It's an uptrend, yes. However, it's an uptrend that you shouldn't really follow, but an uptrend that you should wait for its reversal. Look at the momentum, guys. It's weak and very weak. We should have a move lower. When will the move lower be? I don't really know. We are waiting for that. Another scenario is it's a weak scenario. It's not so highly probable. However, it's still probable because, guys, at the end, the markets can do anything. Markets can behave in any manner that they would. However, it's only a matter of probability. If I personally believe that with a 90% probability that Dow Jones should come down, it doesn't mean 100% probability, or else I would short the Dow Jones with a full margin, okay? And of course, I wouldn't do that. The other minor probability, in my opinion, is yes, we might see an upward move, okay? However, for this to happen, it should be something really surprising to markets, something that is really, really important to markets, or really, I mean, let's say, for example, the FOMC meeting, we have the Jerome Powell after 20 minutes. What if he says that we will no longer raise interest on the dollar and we will start cutting interest rates next meeting? Let's say, for an example, cutting interest rates means that the interest rates on the dollar is lower now. So people will try to invest in other opportunities. The stock market is one of those other opportunities or options. So it definitely should go higher. Very strong, upward move on the Dow Jones is to be expected. In this case, just forget about the technical analysis, forget about the momentum, and forget about everything, because if this happened, the new buying or purchasing power that will happen will provide the momentum that we want. So we will have this upward move on prices as well as an upward move on momentum, and they will start to follow each other. This is a scenario that could happen, theoretically, it could happen. Practically, I don't really believe that will happen. So I'm still, I will still wait for, to short the Dow Jones because, yeah, this is an upward move. All of the upward moves and retracements are interfering in the price range. This is definitely a weak upward trend. Guys, I've explained this before, and yeah, let me explain this really quick one more time. There is a difference between a strong uptrend where corrections doesn't really interfere, okay? So let's say this is a correction. This is a price correction, right? And this is the price range for the correction. This is another price range for a following correction. They don't really interfere. So this is an impulsive move and this is a strong trend, okay? This one, again, is a third correction which doesn't interfere with the price range for the previous correction. Again, a strong trend. A weak trend, however, is something like this. Okay, this is an upward trend, higher highs and higher lows. However, what about the corrections? This is a correction here. However, the following correction interfered in the price range of the previous one. Again, this happened here. This is a weak upward trend. When do we follow the trend? When the price is going higher in a strong trend, corrections are not interfering. However, in this case, if you follow a weak trend, you will lose because it will reverse sooner or later. Yeah. So that's for the Dow Jones, and that's why I'm telling you I'll be waiting to short the Dow Jones. Let's have a look on oil prices. Oil prices has been doing good for some time right now, okay? But without any other look on any time frame, if you haven't, or if you're not long the US oil right now, it's too late to do so. Momentum is already weakening here. After a huge or a very good move to the upside, we can see there is a period of consolidating here. So to me, basically, the US oil is something to short, and I really hope this could turn out as a head and shoulders pattern. At least we will be having a target to short. So if this is a head and shoulders pattern, this should be your target at least to the levels of 77.20. This is something I'll be looking to do on the US oil. However, it's not to be shorted yet. We must, guys, I never trade without confirmation, and you shouldn't, okay? Never trade without confirmation. Wait for the confirmation first, wait for the price action. Even if waiting longer would probably decrease your profits, that's fine. However, it increases your safety, it reduces your risk so much. So to me, in order to short the US oil here, I'll definitely wait for a lower low, okay? Because in this case, just forget about the head and shoulders. We're having a higher high, a higher high here, slightly higher low, and here we have a lower high. In order to short, or for me to short the US oil, I should wait for a lower low, which should be by breaking the 78.60 level. Whenever we break below the 78.60, I'll definitely short the US oil and target the levels of 77.20. That's for sure. And I really believe, or I really hope, this will take place today. What about gold? Sorry, I just joined. We have discussed gold a lot. However, let's have another look here. Okay, what's happening here on the 4-hour time frame? We have discussed gold pretty much, I believe, 1 week ago, or two weeks ago, when we discussed that this is basically a head and shoulders pattern. We had our targets around the 1983. Whenever we reached the 1983, we had this downward move on the momentum indicator. We agreed that we should. Okay, what's happening here? Yeah, here we go. The momentum was basically decreasing as we approached the 1983 level. So we agreed that we should short the gold. However, right now we can see that gold is edging higher. I still really believe that we can target the levels of 1983 on the short term, which will be a make or break level, okay? So just forget about this right now. On the short term, I believe the 1983 level is something that we will see again before deciding the next move, okay? So during the day, this is a clear rounding bottom, okay? This is a bottom here. Slight change in the psychology of the markets from lower lows and lower highs into higher high and higher low, okay? So it's the slight beginning of an upward trend on the hourly time frame on gold, and I believe 1983 is something that we will target. Is it something I'm gonna trade right now? No. We will wait first for the Federal Reserve and the press conference, and after this we will make a decision about trading gold. However, I'm personally more biased to buying gold and selling the US dollar, and we have spoken a lot about the US dollar. What if 1983 break? What our targets are? Good question, a very good one. Simply said, that was a move lower, okay? At least the levels of 2016 is something that we will definitely see, because that was an interchangeable level of support and resistance. See that on the 4-hour time frame, okay? 2016. So you can see this cluster of prices, it was support, broken below, acted as resistance, continued to move lower. If we break above the 1983, the 2016 is something that we would definitely target with. I sometimes want to say 100% probability, but it's not always 100%. So yeah, maybe 90% chance that we will target the 2016. So far, not so far in gold. It's a matter of 30, $34, 340 pips. Yeah, you can see that in 1 week. So yes. 340 pips, yeah. Let's wait and see, my friend. Okay, let me get for you the FOMIC press conference. Yeah, I believe we have all the questions answered. And where's the Federal Reserve? Just hold on, guys. Here we go, July 26th, the FOMIC press conference. Desktop audio is switched off. And switch this off. Okay, so right now I have the FOMIC press conference ready for you guys. It will start in 8 minutes. And during this, I will leave for you those 4 charts. What are those 4 charts? Here you have the dollar index on the 5-minute time frame, gold on 5-minute time frame, the Dow Jones, as well as the S&P. 4 major things to look for during the FOMIC meeting. And as we agreed in the comment section below, I will be writing for you all of the statements or key words from the speech by Jerome Powell. If I'm gonna short 1983, what is my stop loss? It's a hard question, and I'll tell you why. Personally, okay, if this is 1983, and if you have this upward move to 1983, which is something I expect and I hope that we can see in the markets, don't never short as soon as you see bearish price action from here, okay? Because it's a 1 hour time frame. Because maybe you can short after this bearish price action and then you get stopped out. And this is why a lot of traders basically get stopped out. They tell me, okay, we have shorted, we have seen this bearish price action and still got our stop, hit. So what I personally would do is I'll be waiting for this upward move, a downward move, which is a bearish price action, and I'll wait for a lower high. And I'll short from here. Okay, shorting from here, I'll definitely put my stop loss above this high with some room for prices to breathe. And the target should be the previous low, pretty much here. So we have a solid 2-to-1 risk to reward ratio. You're 100% on the safe side. You have waited for bearish price action and you have waited for a lower low, which is pretty much everything that you need to be on the safe side. So yes, that's for gold. We have discussed all of the possible scenarios, whether to short, whether to go long, and how to create the stop loss. Very smart. Thank you. Thank you very much, my friend. And yeah, this is what we discuss on a daily basis. So yeah, if you didn't still subscribe to our YouTube channel, whether this one, which is ONEPRO, or we have another one for our clients in the MENA region, I mean Middle East and North Africa, you can subscribe to our YouTube channels where we discuss on a daily basis what's happening in the markets, either me or one of our fellow analysts in the market research team, either Amr or Shayma, and we always discuss what's happening in the markets. This is our main job, is to provide you with expert analysis so you can trade on the safe side. Yeah, let's get back to this. Okay, quickly, what I normally do is on the 5 hour, 5 minute time frame, if you want to trade during the news, what are the support and resistance levels that we should look for? So the nearest resistance on gold is 1974, support is 1964. Please make sure that you follow the risk management. The nearest support on the Dow Jones, no, just forget about the S&P. Let's work on the Dow Jones. Nearest support is 35,442. I think you can see the numbers, don't you? Wait, I'll make it more clear for you guys. Scales, yeah, let's make it 32. Or no, this is too big. 28, apply to all. Yeah, now it's available for you guys. So those are the support and resistance levels on the Dow Jones as well as gold trading. And on the dollar index, the nearest resistance is 101.36, not so far, and support levels are 101.10, 101.05. You have supports and resistances everywhere in all of the main financial assets. Yeah, let's do the S&P quickly. We are running out of time here. Those are the levels of support and resistance. Guys, I don't really believe that we will see major moves in the markets today unless the Federal Reserve or Jerome Powell, blasts off a bomb or a surprise to the market. I don't really believe that he will provide any useful information. We will continue to depend on data, the economic data, which is the data dependency that we mentioned and explained. And most probably during the next 1 hour, Jerome Powell will say, we don't know, just like the previous meeting. In this case, I don't really believe markets will continue to behave in any extraordinary manner. And we will continue to trade the technicals. If any other thing happens, of course, you will see, some bombs on the chart. Follow the comment section below, and let's get you Jerome Powell right now. Not yet. Should start anywhere, anytime now. Yeah, here we go. I'll meet you guys, or maybe not, after 1 hour. If there is any reason for me to come back and explain further things, I'll come back after the press conference. If not, I'll meet you guys tomorrow. Thank you very much. See you.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. Today, we took another step by raising our policy interest rate a quarter percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the past 3 months, job gains averaged 244,000 jobs per month, a pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 3.8%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In June, the 12-month change in the Consumer Price Index, or CPI, came in at 3.0%, and the change in the core CPI was 4.8%. Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning to inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 5.25% to 5.5%. We are also continuing the process of significantly reducing our securities holdings. With today's action, we've raised our policy rate by 5.25 percentage points since early last year. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of our ongoing monetary restraint to be realized, especially on inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will continue to make our decisions meeting by meeting, based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Steve.
Mr. Chairman, thank you. You have, I think, a couple times in your opening remarks talked about this language in determining the extent of additional policy firming that may be appropriate. Should we take that to mean that additional hikes are likely on the way? And should we also believe that all future meetings, say September and November, are live, or are you in a every other meeting mode? Thank you.
So we haven't made a decision to go to every other meeting. It's not something we've looked at. We're going to be going meeting by meeting, and as we go into each meeting, we're going to be asking ourselves the same question. So we haven't made any decisions about any future meetings, including the pace at which we'd consider hiking. But we're going to be assessing the need for further tightening that may be appropriate. You read the language, to return inflation to 2% over time. I would say that the intermeeting data came in broadly in line with expectations. Economic activity remained resilient. Job creation remained strong while cooling a bit. And the June CPI report actually came in a bit better than expectations for a change. And the June CPI report, of course, was welcome, but it's only one report, 1 month's data. We hope that inflation will follow a lower path it will be consistent with the CPI reading. But we don't know that, and we're just going to need to see more data. So what are we going to be looking at? Really, it will be the whole broader picture, and starting with we're looking for moderate growth, right? We're looking for supply and demand through the economy coming into better balance, including in particular in the labor market. We'll be looking at inflation, and we'll be asking ourselves, does this whole collection of data, do we assess it as suggesting that we need to raise rates further? And if we make that conclusion, then we will go ahead and raise rates. So that's how we're thinking about the next meeting, and how we're thinking about meetings going forward potentially. But we're now mainly thinking about the next meeting. I will also say, since we're talking about it, between now and the September meeting, we get 2 more job reports, 2 more CPI reports. I think we have an ECI report coming later this week, which is Employment Compensation Index. And lots of data on economic activity. All of that information is going to inform our decision as we go into that meeting. I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting. And I'll close by saying we've raised the federal funds rate now by 525 basis points since March 2022. Monetary policy, we believe, is restrictive and is putting downward pressure on economic activity and inflation.
If I could just briefly follow up on something you said there. You said the data in the intermediate period, it broadly came in line with expectations. Does that mean there's unlikely to have been a change in the overwhelming outlook of the committee that 2 more hikes are necessary?
I'm just going to go back to what I said. That's the question. We have 8 weeks now until the September meeting, and all that data that I recited, we're going to be looking at all of that and making that assessment then. And it really, we did have the one good reading, and of course we welcome that, but it's just one reading, as everybody knows. And we've seen this before in the data. Many forecasts call for rates for inflation to remain low, but we just don't know that until we see the data. So we'll be focusing on that.
Gina.
Thank you. Thanks for taking our questions, Chair Powell. Obviously, you upgraded the language around growth in the statement today. We've seen the Barbie movie numbers. We've seen everyone going to Taylor Swift concerts this summer. It seems like the American consumer is in pretty good shape. And it does seem like growth is sort of picking back up a little bit, or at least doing well. And I wonder, from your perspective, if that continues, if we see growth not just stabilizing, but performing well this summer, is that a problem because it's inflationary, or is it good news because it suggests that a soft landing is more likely? Just how are you thinking about that sort of trajectory?
Yeah, so I would say it this way. The overall resilience of the economy, the fact that we've been able to achieve disinflation so far without any meaningful negative impact on the labor market, the strength of the economy, overall, that's a good thing. It's good to see that, of course. It's also, you see consumer confidence coming up and things like that. That will support activity going forward. But you're right, though. At the margin, stronger growth could lead over time to higher inflation, and that would require an appropriate response from monetary policy. So we'll be watching that carefully and seeing how it evolves over time.
Neil.
Thanks, Chair Powell. Neil Irwin from Axios. So as you referenced earlier, in the intermeeting period, soft CPI, jobs reports, still strong but moderating, JOLTS look good. So if you're data dependent, why not pause again? Why not stay on hold? Why not take another meeting off when the data was at least cutting in the direction you want to see?
So if you go back to what we're trying to do here, we're trying to achieve a stance of policy that's sufficiently restrictive to bring inflation down to 2%. At the last meeting, we wrote down our individual estimates of what that would take, and the median of that was an additional 2 rate hikes. So I would say we looked at the intermeeting data, and as I mentioned, broadly consistent, not perfectly consistent, but broadly consistent with expectations, and as a result, we went ahead and took another step. And that's, a labor market that continues to be strong, but gradually slowing. I mentioned that the inflation report was actually a little better than expected, but we're going to be careful about taking too much signal from a single reading. And growth came in stronger than expected. So that's how we look at it, and so we did take that step today.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, markets widely believe the median FOMC participants' inflation forecast from June for the fourth quarter of this year will be too high, given autos and shelter, and that by September that may warrant a downward revision in the inflation forecast of 20 to 30 basis points. Would that type of inflation progress be enough to hold rates steady from here, or do you need to see below-trend growth and decelerating labor income growth to be convinced that you've done enough?
So it's hard to pick the pieces apart and say, how much of this and how much of that. We'll be looking at everything. And, of course, we'll be looking to see whether the signal from June CPI is replicated or the opposite of replicated, or whether it's somewhere in the middle. We'll be looking at the growth data. We'll be looking at the labor market data very closely, of course, and making an overall judgment about that. It's the totality of the data, I think, but with a particular focus on making progress on inflation.
If I could follow up, last month you said there were benefits to moderating the pace of increases because it would give you more information to make decisions. Would another CPI report like the one we just had in June allow you to at least maintain that slower pace and defer until the fall any decision on whether you need that second rate hike?
So I'm just going to tell you again what we're going to do in September. We're going to look at 2 additional job reports, 2 additional CPI reports, lots of activity data. And that's what we're going to look at, and we're going to make that decision then. And that decision could mean another hike in September, or it could mean that we decide to maintain at that level. And again, the question we're going to be asking ourselves is the overall signal one that we need to do more, that we need to tighten further? And if we get that signal whenever we get it, then, and that's the collective judgment of the committee, then we will move ahead. If we don't, then we'll have the option of maintaining policy at that level. But it's really dependent so much on the data, and we just don't have it yet.
Chris.
Hi, Chris Rugaber at Associated Press. So consumer confidence in the economy is rising, likely in large part because of the declines in headline inflation. You also see wages are also rising faster than prices now, after trailing them for a long time. How much are Americans truly harmed by inflation at its current level, headline level of 3%? And with that in mind, when do you put some weight back on the employment side of the dual mandate?
So I guess I'd say it this way. First, it is a good thing that headline inflation has come down so much, because that's really what the public experiences. And I would say that having headline inflation move down that much almost creates it will strengthen the broad sense that the public has that inflation is coming down, which will in turn, we hope, help inflation continue to move down. So you are really, sorry, well, your question was?
Well, I mean, you've talked for many press conferences now about the harm created by inflation, how hard it
Yeah.
is for people. So how much of that are we still seeing with inflation now down at 3?
So I guess I would put it this way. I'd say it this way. It's really a question of how do you balance the two risks, the risk of doing too much or doing too little. And, I would say that, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not, but as our stances become more restrictive and inflation moderates, we do increasingly face that risk. But we need to see that inflation is durably down that far. As you know, we think, and most economists think, that core inflation is actually a better signal of where headline inflation is going, because headline inflation is affected greatly by volatile energy and food prices. So we would want core inflation to be coming down, because that's what we think, core is signaling where headline's going to go in the future. And core inflation is still pretty elevated. There's reason to think it can come down now, but it's still quite elevated. And so we think we need to stay on task, and we think we're going to need to certainly hold policy at a restricted levels for some time, and we need to be prepared to raise further if we think that's appropriate.
Well, and then if inflation were to, just a quick follow, if it stays at 3 or drops even a little bit more, I mean, how much of an increase in unemployment do you think is acceptable to get that last bit of inflation? People are talking about the potential difficulty of the so-called last mile of inflation. So, but how much unemployment do you think is justified to get down that last?
So it is a very positive thing that actually the unemployment rate is the same as it was when we lifted off in March of 22 at 3.6%. So that's a real blessing, and that we've been able to achieve some disinflation. And we don't seek to, it's not that we're aiming to raise unemployment, but I would just say the historical record, we have to be honest about the historical record, which does suggest that when central banks go in and slow the economy to bring down inflation, the result tends to be some softening in labor market conditions. And so that is still the likely outcome here. And we hope that that's as little as possible. We have to be honest that is the likely outcome. The worst outcome for everyone, of course, would be not to deal with inflation now, not get it done. Whatever the short-term social costs of getting inflation under control, the longer-term social costs of failing to do so are greater, and that the historical record is very, very clear on that. If you go through a period where inflation expectations are not anchored, inflation is volatile, it interferes with people's lives and with economic activity, and that's the thing we really need to avoid and will avoid.
Go to Michael McKee.
At this point, you say the policy is restrictive, but all year long we have seen growth surprise to the upside, unemployment to the downside, and inflation lately to the downside. So I'm wondering, by definition, should you be restrictive enough right now under these conditions? Do you think you might need to do more? Because I'm curious about what you see as inflation dynamics now. Is the economy still moving in a direction where it creates more inflation? People talk about base effects and higher energy costs, and now we have some large labor settlements. Or is the economy disinflating, and you're able to go back to the old Fed policy of opportunistic disinflation?
So I'll just say, again, the broader picture of what we want to see is we want to see easing of supply constraints and normalization of pandemic-related distortions to demand and supply. We want to see economic growth running at moderate or modest levels to help ease inflationary pressures. We want to see continued restoration of supply and demand balance, particularly in the labor market, and all of that should lead to declining inflationary pressures. Now, what we see is those pieces of the puzzle coming together, and we're seeing evidence of those things now. But I would say that what our eyes are telling us is that policy has not been restrictive enough for long enough to have its full desired effects. So we intend, again, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate. And we think the process, still probably has a long way to go.
Well, do you think under current conditions you are restrictive enough unless something changes?
Well, I think We think, today's rate hike was appropriate, and I think we're going to be looking at the incoming data to inform our decision at the next meeting about is the incoming data telling us that we need to do more, and if it does tell us that, collectively, if that's our view, then we will do more.
Colby.
Thank you. Colby Smith with the Financial Times. If September is in fact a live meeting, how does that square with the need for a more gradual tightening pace that you spoke of last month in explaining the rationale for holding the funds rate steady at the June meeting?
So a more gradual pace doesn't go immediately to every other meeting. It could be 2 out of 3 meetings, right? It just means if you're slowing down. The point really was to slow down the decision cycle as we get closer and closer to, we think, our destination. And I wouldn't want to go automatically to every other meeting because I just don't think I think it's not an environment where we want to provide a lot of forward guidance. There's a lot of uncertainty out there. We just want to keep moving at what we think is the right pace. And I do think it makes all the sense in the world to slow down as we now make these finally judged decisions. And so that's what we did. And so I think it's possible, I mentioned before, it's possible that we would move at consecutive meetings. We're not taking that off the table, or we might not. It's really going to depend on what the data tell us. That's the best we can do.
So we shouldn't assume that every other meeting is the lowest tightening frequency, let's say. It could be, longer intervals in between as well.
I think we're going to make a decision about the next meeting, and then we're going to make a decision about the one after that, and I think it'll sort itself out.
Thanks. Howard Schneider with Reuters. Among your colleagues, there have been people who've said they feel that very little transmission has taken place so far from monetary policy into the economy, and there are those who feel, they say, it's happened very fast this time and it's kind of up to date. Where are you on that continuum?
So there's a long-running debate about the lags between changes in financial conditions and the response to those changes from economic activity and inflation, right? So we know that in the modern era, financial conditions move in anticipation of our decisions, and that has clearly been the case in this cycle. So in a sense, the clock starts earlier than it used to, but that doesn't necessarily change the process from that point on, and it's not clear that it has. I'll tell you what we know and then what we don't know. We know that financial conditions affect economic activity and inflation with a lag that can be long and variable, or lags, plural, that can be long and variable. A lot of uncertainty around the length of the lags, and by the way, that's just one component of the broader uncertainty that we face. So I'll tell you how I think about this. The first thing to say is we're determined to bring inflation down to 2% over time, and we will use our tools to do that. No one should doubt that. I would look at it this way, though. The real federal funds rate is now in meaningfully positive territory. If you take the nominal federal funds rate, subtract a mainstream estimate of near-term inflation expectations, you get a real federal funds rate that is well above most estimates of the longer-term neutral rate. So I would say monetary policy is restrictive, more so after today's decision, meaning that it is putting downward pressure on economic activity and inflation. We'll keep monetary policy restrictive until we think it's not appropriate to do so. So that's how I think about it. I mean, if I sum it up, I would say we've come a long way. We are resolutely committed to returning inflation to our 2% goal over time. Inflation has proved stronger than we and other forecasters have expected. And at some point that may change. We have to be ready to follow the data, and given how far we've come, we can afford to be a little patient as well as resolute as we let this unfold.
On the credit side, I'm wondering if you saw anything in the latest SLOOS data that made you think you're getting a quantum of credit contraction beyond what you'd expect. The bank lending data really is, the growth rates edging down towards and heading below zero, which is usually a recession indicator.
So I guess the SLOOS will come out early next week, and I would just say it's broadly consistent with what you would expect. You've got lending conditions tight and getting a little tighter. You've got weak demand, and it gives a picture of pretty tight credit conditions in the economy. I think it's really hard to tease out how much of that is from this source or that source, but I think what matters is the overall picture is of tight and tightening lending conditions, and that's what this SLOOS will say.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. Could you break down the reasons why inflation has fallen and what share of that credit you would give to factors that don't stem directly from rate hikes or that might be within your control at all, like easing supply chains and a drop in energy prices over the past year?
Yeah. So, interesting question. So, let me start by saying that the inflation surge that we saw in the pandemic resulted from a collision of elevated demand and constrained supply, both of which followed from the unprecedented features of the pandemic and the response from fiscal and monetary policy. And we've always expected that the disinflationary process would stem from both from the normalization of those broad pandemic-related supply and demand conditions and from restrictive monetary policy, which would help return the balance between supply and demand by restraining demand. And we think that's broadly what we're seeing. So to go break it down a little further, of course, headline inflation has come down sharply from elevated levels as energy and food prices have come down, mostly due to reversal of the effects from the war in Ukraine. And that's a good thing, and the public experiences that, as I mentioned earlier. For core inflation, I'd say there has been a role for both factors, both that I mentioned. Clearly, for goods, normalization of supply conditions is playing an important role, as is the beginning of the reversal of spending back into services and away from goods. Say, take autos as an example. The combination of an increase in sales and inventories, while vehicle inflation has decelerated, points to a substantial role for supply. But there's also a role for demand, as the loans and things like that are more expensive. So they're both working there. Housing services inflation now starts to move down. Clearly, higher rates have slowed the housing market. I would say monetary policy is working about as we expect, and we think it'll play an important role going forward, in particular in non-housing services, where really we think that's where the labor market will come in as a very, very important factor. So we think both of those sources of disinflation are playing an important role.
I see. And just to follow up, do you think that of those two sources, that core will rely more heavily on seeing an impact from rate hikes, or is there a more even split there too?
I think monetary policy is going to be important going forward, because we're sort of reaping now the benefits of the reversal of some of the very specific pandemic things. We're seeing that with goods in particular, with supply chains and shortages moving, and we're seeing. So I think going forward, monetary policy will be important, particularly in the sector, in the non-housing services sector.
Edward.
Thank you, Chair Powell. First, let me compliment your tie, the choice of tie. So thanks for taking our question. So the Beige Book, it said, input cost pressures remain elevated for services firms, but eased notably for manufacturing sector. Is that an indication that there's a wage inflation pressure? And how do you target and pressure on the wage inflation without pushing the economy into recession?
I think as it relates to goods, it's really an indication that supply chains and shortages are easing. And so what was the first part of it?
So wage inflation, like how do you target wage inflation without pushing an economy into a recession?
I don't think we're targeting wage inflation. I think what we're looking for is a broad cooling in labor market conditions, and that's what we're seeing. So wages have actually been gradually moving down. They're still at levels that would be consistent over a long period of time with 2% inflation. Nonetheless, we're making progress there. And by so many indicators, labor market demand is cooling. You can look at surveys by workers and businesses who see that. You can look at the quits rate normalizing. You can look at job openings coming down. You can look at just job creation in the establishment survey has, it's still at a high level, but it was at really an extraordinarily high level for most of the last 2 years. So you see cooling, particularly in private sector in the last in the last report. So I think we see that, and it's happening at a gradual pace. So that's actually not a bad thing in a sense, because if what we see is a labor market, very strong demand for labor, which is really the engine of the economy. People are getting hired, many people going back to work, getting wages, spending money, and that's really what's driving the economy. But that it's gradually slowing, it's gradually cooling. That's a good prescription for getting where we want to get.
But still, we see a push to raise minimum wage. We're seeing a lot of unions go on strike or threaten strike. And the common thing is they come out with agreements like big pay increases, like UPS, and we have the auto workers coming up. Are you concerned then about a trend of series of big unions, these contract pushing wage inflation then?
Not for us to comment on contract negotiations. Not our job, not our role. We monitor these things and we'll keep an eye on them. But really, that's something that's handled at that level. And not,
a large amount of people.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask about the SEP, which suggests that you would cut rates as overall and core PCE get to around or under 3%. And so I'm wondering, is the level of inflation what's sort of important there as you think about getting to 2% and when you might start cutting rates, or is the speed at which inflation is falling also important?
I think you'd take both into account. I think you'd take everything into account when you start cutting rates. It would depend on the whole, on a wide range of things. And when people are writing down rate cuts next year, it just is a sense that inflation is coming down and we're comfortable that it's coming down and it's time to start cutting rates. I think, but I mean, there's a lot of uncertainty between what happens, in the next meeting cycle, let alone the next year, let alone the year after that. So it's hard to say exactly what happens there, what's motivating people.
So if it's sort of stubbornly in maybe the high twos, you wouldn't necessarily cut rates.
I'm not saying that at all. I'm not giving you any numerical guidance around that. I'm saying we'd be comfortable cutting rates when we're comfortable cutting rates, and that won't be this year, I don't think. It would be, many people wrote down rate cuts for next year. I think the median was several for next year, and that's just going to be a judgment that we have to make then, a full year from now, and it'll be about how confident we are that inflation is in fact coming down to our 2% goal.
Steve.
A good part of Wall Street has become more confident that the Fed is going to be able to engineer a soft landing, and they've reduced their forecast for a recession. And I'm wondering if the staff has changed its view on the likelihood of recession being likely, and if you personally have changed your view in terms of becoming more confident that you can achieve a soft landing.
So it has been my view consistently that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours. That's been my view. That's still my view, and I think that's sort of consistent with what I see today. So, but it's a long way from assured, and we have a lot left to go to see that happen. So the staff now has a noticeable slowdown in growth starting later this year in the forecast, but given the resilience of the economy recently, they are no longer forecasting a recession. I just want to note that that our staff produces its own forecast, which is independent of the forecast that we as FOMC participants produce. Having an independent staff forecast as well as the individual participant forecast is really a strength of our process. There's just a lot of, I think, constructive diversity of opinion that helps us make, informs our deliberations, helps us make, I hope, better decisions.
And is the reason for optimism that inflation has come down and you still have a strong labor market? I mean, does that add to the optimism?
I wouldn't use the term optimism about this yet. I would say, though, that there's a pathway. And yes, that's a good way to think about it. We've seen so far the beginnings of disinflation without any real costs in the labor market, and that's a really good thing. I would just also say the historical record suggests that there's very likely to be some softening in labor market conditions, and consistent with having a soft landing, you would have some softening in labor market conditions, and that's still likely as we go forward with this process. But it's a good thing to date that we haven't really seen that. We've seen softening through not through unemployment, not through higher unemployment. We've seen softening through job openings coming down part of the way back to more normal levels. The quits rate, so people are not quitting as much. We've seen participation, people coming in, and so labor supply has improved, which has lowered the temperature in the labor market, which was quite overheated, going back a year or so. So we're seeing that kind of cooling, and that's very healthy, and we hope it continues.
Jeff.
Thank you, Mr. Chairman. Jeff Cox from CNBC.com. You and other Fed officials in the past have suggested that you don't need to keep hiking until inflation hits 2%, that as long as you see continued progress. So I'm wondering, how close do you need to get with the inflation numbers coming down? How many months of data do you need to see that will give you sufficient confidence? And how far does this fight need to go before you're willing to kind of declare victory on it?
So the idea that we would keep hiking until inflation gets to 2%, it would be a prescription of going way past the target. That's clearly not the appropriate way to think about it. So. In effect, if you look at our forecasts, the median participant, and again, these are forecasting out years, so take them with a grain of salt, but people are cutting rates next year because the federal funds rate is at a restrictive level now. So if we see inflation coming down credibly, sustainably, then we don't need to be at a restrictive level anymore. We can move back to a neutral level, and then below a neutral level at a certain point. I think we of course would be very careful about that. We'd really want to be sure that inflation is coming down in a sustainable level. And it's hard to make. I'm not going to try to make a numerical assessment of when and where that would be, but that's the way I would think about it. Is you'd stop raising long before you got to 2% inflation, and you'd start cutting before you got to 2% inflation too, because we don't see ourselves getting to 2% inflation until all the way back to 2 until 2025 or so. So.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. It's been over 4 months since a handful of regional banks, including Silicon Valley Bank, failed. When you look at credit conditions now, given Banc of California's acquisition of PacWest, does this acquisition suggest the full impact has not been felt, or are you comfortable saying that we've seen most of the ripple effects that may have occurred at this point, and how does this play into your outlook for policy?
So I don't want to comment on any particular merger proposal, but I will say things have settled down for sure out there. Deposit flows have stabilized, capital and liquidity remain strong. Aggregate bank lending was stable quarter over quarter and is up significantly year over year. Banking sector profits generally are coming in strong this quarter, and overall the banking system remains strong and resilient. Of course, we're still watching the situation carefully and monitoring conditions in the banking sector. In terms of the actual effect on, if you think of a particular set of banks that were affected because of their size and business model and things like that, that were more affected by the turmoil in March than others, it's very hard, as I mentioned, it's very hard to sort of tease out the effects on this very large economy of ours from them tightening. They may be tightening a little bit more, probably are, than other banks. The SLOOS has been telling us for more than a year that banking conditions are tightening. That process is ongoing, and that will restrain economic growth. So I think we have to take a step back from. I can't separate those anymore. I think basically we're just looking at the overall picture, which is one of tightening credit conditions, and that's going to restrain economic activity. It is a restraining economic activity. So that's how I would look at it.
And how is that informing your outlook for setting policy?
So I think that is an expected result of tightening interest rate policy, is that bank credit conditions bank lending conditions would tighten as well. And so the question is it more effective this time because of what happened in May? I just don't think we know that. I think we're looking at the current data in GDP, and we're seeing strong spending, we're seeing a strong economy, and it's made us confident that we can go ahead and raise interest rates now for the third time since the March events. It seems like the economy is weathering this well, but of course we're watching it carefully and expect to continue to do that.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I wondered on wages if you were at all concerned about any inflationary impact of wages now outpacing inflation, which is likely contributing to the boost in consumer sentiment and the continued strength of the consumer that we've been seeing.
Well, wages in excess of inflation means real wages are positive. Again, that's a great thing. Of course, we want that. We want people to have real wages, but we want wages to be going up at a level that's consistent with 2% inflation over time. As I mentioned, nominal wages have been coming down gradually, and that's what we want to see. We expect to see more of that. That's just more of what's consistent over a longer period of time. We don't really think that wages were an important cause of inflation in the first year or so of the outbreak, but I would say that wages are probably an important issue going forward. Labor market conditions broadly are going to be an important part of getting inflation back down, and that's why we think we need some further softening in labor market conditions.
This goes sort of to the balance of risks question, but you mentioned at the start how you're keeping an eye on consumer activity and whether there might be some sort of a rebound there. And I'm curious what the Fed's explanation would be to families if further interest rate hikes start to hit the labor market, start to drive that sentiment back down. What's the message there of why you continue to keep rates elevated or to raise them?
Well, we have a job assigned to us by Congress to get inflation under control, and we think the single most important thing we can do to benefit those very families, especially families at the lower end of the income spectrum, is to get inflation sustainably under control and restore price stability. We think that is the most important thing we can do now, and we're determined to do that. And I would just point out that the people who are the most hurt by inflation right away are people who are on a low fixed income, who, when you're talking about travel or transportation costs, heating costs, clothing, food, things like that, those, if you're just making it through each month on your paycheck and prices go up, you're in trouble right away. Even middle class people have some resources and can absorb inflation. People in the lower end of the income spectrum have a harder time doing that. So we need to get this done, and the record is clear that if we take too long or if we don't succeed, that the pain will only be greater. So that's how I would explain what we're doing.
Thank you, Chair Powell. Simon Urbanovich with The Economist. You had said last month that this meeting this week was going to be a live one. In the event the market had assigned a roughly 99% probability to the rate move that you announced today, the decision was, of course, unanimous. And the statement was basically unchanged from last month. So may I ask, to what extent was the meeting actually a live one? Was there ever any doubt over the past 2 days about what the decision was actually going to be?
Well, I mean, was there doubt? I would say there's a range of views on the committee, and when you see the minutes in 3 weeks, you'll see that. There's a range of views about what we should do at this meeting and what we should do at the next meeting, and it's a process that we go through. Many times when we go into a meeting, the decision is not, fundamentally in doubt. Nonetheless, we have the meeting, and some meetings are less uncertain than others, and I'll just leave it at that.
Evan Reiser, Market News International. Thank you, Chair Powell. Financial conditions have been loosening at a fairly steady clip in recent weeks, the dollar, the stock market, et cetera. What does that mean for the Fed in being sure that inflation will come down to target?
So we monitor, of course, financial conditions, broad financial conditions. You're right, it's the dollar and equities, and we're of course very focused on rates and our own policy. We're going to use our policy tools to working through financial conditions to get inflation under control. The implication is, we will do what it takes to get inflation down, and in principle, that could mean that if financial conditions get looser, we have to do more. But what tends to happen, though, is financial conditions get in and out of alignment with what we're doing, and ultimately, over time, we get where we need to go.
If I could also ask about the SEP from June that showed rate cuts. Do you expect the Fed to cut nominal rates next year while also continuing QT?
So that could happen. The question is, is that consistent with? So if you think about both of them as normalization, imagine it's a world where things are okay, and it's time to bring rates down from what are restrictive levels to more normal levels. Normalization in the case of the balance sheet would be to reduce QT. So. To continue it, you depending on where you are in the cycle. So they're two independent things, and really the active tool of monetary policy is rates. But you can imagine circumstances in which it would be appropriate to have them working in what might be seen to be just different ways, but that wouldn't be the case.
Let's go to Kyle.
Thanks, Chair Powell. Kyle Campbell with American Banker. I have a question about the discount window. I'm wondering if since the bank failures of the spring, if you've seen signs that banks have taken more steps to be proactive in assuring that they're ready to use that facility if they need to. And if you have any sort of thoughts on whether policies might be appropriate for making sure that banks sort of test regularly to show that they are prepared to use it. Thanks.
So that's a very important thing, yes, and yes to both sides of that. Yes, banks are now working to see that they are ready to use the discount window, and we are strongly encouraging them to do that, banks broadly. We did find, as you know, during the events of March, and that that it's a little clunkier. It can be a little clunkier and not as quick as it needs to be sometimes. So why not be in a situation where you're just much more ready in case you need to access the discount window?
Let's go to Mark.
Mr. Chairman, Mark Hamrick with Bankrate. You've talked in the past about getting the housing market back into better balance, excuse me, and also that the market might have bottomed. Where do you see that situation and balance, or lack thereof, right now, particularly with the constrained inventory of existing homes that might otherwise be coming onto market at a time when existing homeowners are reluctant to move? And of course, all of that happening with the 30-year fixed rate mortgage still around 7% on the heels of Fed tightening, and with what you're talking about, tightening industry lending standards. Are we getting closer to balance or farther away? What's your sense?
I think we've got a ways to go to get back to balance, really for the reasons that you talked about. With existing homes, there are many people who have low-rate mortgages, and whereas they might want to sell in a normal situation, they're not going to because they have so much value in their mortgage, which means that supply of existing homes is really, really tight, which is keeping prices up. On the other hand, there's a lot of supply coming online now, and there are people coming in. A lot of the buyers are first-time buyers coming in at buying it with these relatively elevated mortgage rates. But I think this will take some time to work through. Hopefully more supply comes online, and we work through it. We're still living through the aftermath of the pandemic.
We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Russia has pulled out of an agreement allowing shipments of grain safe passage through the Black Sea, and alternative routes at this point could be closed off. Just wondering, how could that contribute to higher food prices and inflation generally, and how closely are you watching that?
We are watching it, of course, very closely. And you're right, the withdrawal from the Black Sea Grain Initiative does raise concerns about global food security, particularly for poorer countries that import a large share of their food. Grain prices did go up on this news, but they remain well below their peaks of last spring. And the moves that we've seen so far, I would say, are not expected to make a significant contribution to U.S. inflation. Of course, we will be watching that situation carefully.
So you don't think it would have a big effect on Fed policy at this point?
You wouldn't say so looking at what we know now.
Thank you.
Thanks very much.